Hi, moving average is the most basic and the most widely used tool in trading, and I personally use it to make tens and thousands of dollars. Now, in this video, I'm going to tell you everything you need to know about moving averages, and this is going to be the first video of a new series which I am starting, and that series is called as Moving Average Mastery Series. So, that series will include everything you need to know about moving averages, like the different types of moving averages, what are moving averages, how does it work, also which period of moving average you should use, and which moving average will be right for you. Also, at the end, that is the last video, will be about the different moving average strategies which I personally use. So if you don't want to miss out on those videos, then make sure you subscribe to this channel and watch this video all the way to the end. Now let's get started and understand what are moving averages. So moving averages is a tool that helps you find the average price of any currency pair. So let us take an example to understand this. Let us first go to a Forex chart, which will be, let us go to or JPY. So now we are on Australian dollar and Japanese yen. Now let us say that we have 5 prices with us. That is 20 is the price of day 1, and then we have 30, which will be the price of day 2. Then we will have 40, which will be the price of day 3. Then let us say 35 will be the price of day 4, and then we will have the next price, which will be 45, and this will be the price of day 5. So now we have prices of 5 days. Now if I asked you to find the average of all these prices, what will you do for that? It is simple. You will just add all of these and then divide them by the number of days. So what will we do here is, let us say 20 plus 30, which will be equal to 50, and then 90, and then 130, and then 170. Okay, so 170 divided by 5, which will be 34, around 34. So the average price we will get will be 34. Now this is the same thing which the moving average does for us. Now let us say we have a price reading for another day, which will be the 6th day in this case, and that is 50. Now if we need to find the average of 5 days, what we will do is we will exclude this and then we will find the average of this. Okay, so the average of these 5 days was 34, and now the average of the next 5 days, excluding the first one, let us say we get an average price which will be 40. So let us take another day, which will be the 7th day, and here the price will be 60, and now we will exclude this and we will consider these 5 as we are finding the average of 5 days. So let us say this time we get an average price of 45. Now let us take another day, that will be the 9th day, 1 2 3 4 5 6 7 8th day, and let us say the price is 70. So this time again we will exclude this, and then we will get an average of these 5 days, that is 1 2 3 4 and 5. So let us say this time we got an average price of 60, right? So now we have an average price of day 6, day 7, day 8 and day 9. So we have an average price that is 40, then we have 50, then 55, and then we have 60. So what's happening here is we got an average price of these days, and now if we try to draw this on a price chart, let us say if we are trying to draw this on the price chart, let us say this is 40, then 50 will be somewhere near here, and then 55 and then 60. So if we draw it on a price chart, and if we connect the dots, we will get a slope, and this slope is called as the moving average. Now, as we can see here, the average price was increasing. Therefore, we are getting a slope which is in the upward direction, and this tells us that the price is moving up or the price is bullish. Now, this is what the moving average does. So now that you know what moving averages are and how does it work, you need to know that there are different types of moving averages, and those are different only because the formula which they use is different. Like, there are 4 different types of moving averages. The first one is the simple moving average, then there is the exponential moving average, then there is weighted moving average, and then there is smoothened moving average. Now these are only different from each other because the formula they use are quite different from each other, or else they all does the same thing, that is, tells us the direction of the market and finds the average price for us, which help us to get in the market and be with the trend. Now we are going to learn about all the different types of moving averages later in this moving average mastery series. Now let us move to the final part, which is understanding the psychology of the moving averages, and this is going to be the most important part because this will help you when you will use the strategies which I am going to tell you later in this series. So let us go to the chart and understand the psychology behind the moving average. Now here we are on Australian dollar and Japanese yen, and we are on 1 hour chart. So let us try to understand what does the moving average tell. So as I told you before, when the slope of the moving average is up, that is, when the slope of the moving average is up like this and the price is above it, then it tells us that the market is bullish. And what traders do is they understand that they have to be with the trend, and they try to take mostly long positions or take buy trades when the price is above the moving average. Now let us say when the price is below the moving average and when the slope is moving down. When something like this happens, this tells us or the traders that the price is moving down and we are in a bearish trend, that the trend is down. So what they do is they try to enter sell trades and short the market. Now, so the moving average also tells us about the direction of the market. That is, when the moving average, the slope of the moving average is up, the market is in an uptrend. When the slope of the moving average is down, the market is in an downtrend. It also tells us about the third type of market, that is the ranging market. And when the price or the moving average is moving sideways like this, and the price is not respecting the moving average and is moving sideways, then we have a ranging market. So this is how traders use moving average, and this is the psychology behind this. So that is all about moving averages. Now in the next video, I'm going to tell you about SMA and EMA and which one should you choose. So make sure you subscribe to this channel so that you don't miss out on the upcoming video. Thank you so much for watching.